Right, hi guys, so I'm back and it's been quite a while since my last video. If you don't know, I've been on vacation in the Scandinavian region. I was in Denmark, Sweden and Norway, and if you're from there, I must say that you've got a beautiful country. I loved it, I loved the food, I loved the people, very friendly. The only thing I found was that things were pretty expensive. I'm from Singapore, and people in Singapore, they say the cost of living here is getting higher and higher. Well, it is, but it's nothing compared to these Scandinavian countries. I was pretty shocked that a public toilet was like €1. Coffee was like 3 to 4 euros in a cafeteria in a normal place, and an average meal in a cafeteria costs like 10 to 12 euros. In Singapore, though cars and houses are expensive, you can still get a cup of coffee for €1. You can get a simple meal at a hawker center for €3. But what really blew my mind was the taxes. In Norway, for example, or Denmark, the personal income tax was 30 to 40%. 30 to 40%! And the highest income tax bracket, if you're rich, was 80% tax. If I was living there, I would have no incentive to work at all. Right? Already in Singapore, I'm already complaining that I'm already in the highest income tax bracket in Singapore, making millions of dollars, but even then my effective tax rate is less than 15% with no capital gains tax and no tax on dividends. So yeah, I love traveling there. It was a great vacation, but I wouldn't want to live there. I prefer living in Singapore. So anyway, let's get back to the video. And in this video, let's take a look at what's going to happen likely in the last quarter of the year based on the charts, based on the technical analysis, and based on the macro economic developments. Okay, so let's begin with the charts. Over here, we've got the S&P 500. Let's begin by looking at the daily candles, the daily time frame, and we remain on an uptrend. We remain in a bull market that started in October of last year. As you can see, the 50 moving average is still above the 150 moving average, telling us that the medium-term trend is up. We've got the market above the 200-day moving average. The 200-day is sloping up. So the medium-term trend, the long-term trend is very much on an uptrend. We're in a bull market, but of course we're going through a short-term pullback or a short-term downtrend here. You can see the 20 EMA below the 40 EMA. So this is a short-term downtrend in a medium to long-term bull market. All right, and year to date, the S&P is up about 11.8%. It was up 19% in July. But then, of course, we had that pullback in the last 2 months, which are seasonally weak months of the year, August and September, right? And seasonally, the last 3 months of the year tend to be strong. It tends to be bullish. Again, not all the time, but more often than not. So will it happen this year? Well, let's take a look at the charts. Let's take a look at what's happening to the economy, and let's make some educated guesses. Now, what's interesting was that last Friday, the market initially opened low. It opened down, but then it closed with a strong bullish engulfing candle on the daily time frame. So that's a very bullish signal. Now on the weekly time frame, let me just zoom out to the weekly time frame. You can see that the S&P closed with a bullish pin bar. Okay, so daily time frame bullish engulfing, weekly time frame bullish pin bar. That's a strong reversal signal. Now on Friday, I was pretty certain, okay, we're at the bottom of this short-term pullback. We should go higher to the end of the year. But something happened over the weekend. That's right, Hamas decided to attack Israel. Why? Why start another war? Now we've got 2 wars, Ukraine and the Middle East war again. All right, and now of course this war could blow up. The US is sending the aircraft carrier over there. They are saying that Iran was involved, so the US may attack Iran. The US is supporting Israel, so this whole thing could blow up. So because of that, could the market now go down even more in the short term because of this war? Yes, it is possible. Not a guarantee, but it is possible. But of course, any kind of downside volatility because of all these wars is usually short-lived, and usually the market will bounce back in time, right? So if you're an investor, no need to get panicked. Oh, it's a war, gonna sell. No, just hold steady to your investments if you're holding on to good companies. Now, when the market opened this morning, you can see the futures were initially down pretty much. Futures were initially down on the S&P, down 0.8%. So we had a pretty bearish candle on the S&P futures. It's the /ES S&P futures, which kind of like anticipates how the market will open later on. But so far, the futures have recovered quite a bit. So now it's down like 0.47%. It's turned into a bullish candle so far. We never know. So we'll have to see what happens when the market opens. It's hard to say, by the time the market opens, the market may realize that it's just another war, no big deal, no biggie, let's continue going up, and then, okay, it'll be fine, right? But if the market feels that, this war's going to get out of hand, oil prices may fly up too much, and then the market could go down. So I'm watching it very carefully. Let's see what happens. So far right now, it looks like the market is kind of like recovering its futures pricing. Now, initially, when the war broke out, you can imagine what happened to oil, right? Yeah, usually whenever there's a conflict in the Middle East, oil will go up because there's a fear that supply will drop and then oil prices will go up. And of course, that will affect inflation again. But of course, remember that the Fed doesn't look at oil prices in determining whether to raise interest rates, because oil is something they know they can't control with high interest rates, right? So what's interesting is that initially, let's take a look at the oil futures, okay? So initially, you can see the oil futures jumped up, right? On the news of the war, the oil future jumped up over there and then went all the way up, but now it has kind of like reversed back down. So it looks like the market is now slowly beginning to realize that war, whatever, let's continue. Okay, so hopefully the market will not care too much about the war, and we will open or at least close bullish again when the actual market opens. Let's see how it goes. So why did the market close very strongly on Friday? Well, there are a few reasons. First was a technical reason. The market was very, very oversold on Friday. The put-call ratio was at a very high level. We had the extreme fear on the fear-greed gauge. And of course, we had old Einstein that appeared as well. So all those factored in for the market to kind of like rebound from oversold levels. At the same time, the market was also at near a strong level of support. Recall I've said this earlier on in my previous videos that 4169 was a very strong level of support that we had to look out for. Because if you take a look at the bottom of the COVID crash and you connect that to the low of the bear market last year, it forms a pretty strong, significant trend line, which was again tested during this pullback over here. And now we are approaching that exact same support level on that trend line. So let me zoom in a bit more. So there you go, that's our trend line support. And this trend line also coincides with the 50 moving average on weekly candles, and also coincides with the 200 moving average on daily candles, and also coincides with this previous level of resistance. Remember that when price breaks resistance, resistance becomes potential support. So we've got all these confluence of factors, right? 200 moving average, we've got these trend line support, horizontal support, market oversold. So all these are ingredients that were very, very powerful in reversing this sell-off in the markets to again close with a pretty bullish candlestick pattern. So if not for this new war starting, I'm pretty confident the market has bottomed and will fly back up. But now with this war starting, it's a joker card. We have to see how it plays out right now. Now let's take a look at the kind of like the macro development, the macroeconomic development in the US, and how that kind of like played into this reversal on Friday. So again, Friday, initially the market opened down. The market sold off on Friday, but by the end of the day, it reversed back up. Why? Initially, the market sold off because of stronger than expected employment data. So what happened was that analysts were expecting that the US would create 170,000 new jobs. But instead, the US created 336,000 new jobs. So jobs, the creation of jobs was stronger than expected. As you can see, it accelerated in the last 4 quarters, and then the market sold off. Let me say, that doesn't make sense. Isn't more jobs good for the economy? Isn't it good for spending? Isn't it good for companies? Yes, but we're in a very strange period where good news becomes bad news in the market. That's why I keep saying that in the short term, the market is not always rational. The market can be pretty irrational and pretty emotional. So why was this initially perceived as bad that sent the market down? Because the market initially thought that if job growth is so strong, the economy is so strong, that could create more inflation. And then the Fed will have no choice but to raise interest rates. That's why the market went down. But then the market reversed when it realized that, wait a minute, even though jobs were being created, but inflation is actually not that bad. Because what then came out was that the average hourly earnings increased only 0.2% month on month versus the expectation of a 0.3% increase. So you can see that US wages are still growing, but they're growing at a lower rate. So this shows that while more jobs are being created, it is not contributing to more inflation because the job wage growth is decelerating. And that's why the market realized, okay, that's not too bad, and it boom, reversed very strongly towards the close of the market. So when I initially saw this, I felt that the initial sell-off didn't make sense. And that's why if you're in my community, you know that I used that opportunity to buy more shares. And then when it went up, I was like, all right, good, okay? So to me, when I initially read the employment report, I felt that it was kind of like the best of both worlds. Because on one hand, we had better than expected job creation, which is good for the economy, which is good for consumer spending, which is good for corporate profits. But on the other hand, we had wages rising less than expected, which is good for pulling back down inflation. So the initial drop, I would say, was a classic fake out for the bears, a bear trap, and the market reversed back up. And again, if not for the war, I would say that would have definitely been the bottom of this pullback, and then we rally very strongly towards the end of the year. So first, let's focus on the positives. We have got inflation that has been cooling. Again, last week we had US core PCE, which is the Fed's preferred inflation indicator, showing its smallest monthly rise since late 2020. So core PCE was up 0.1% month on month, below the prior month 0.2% increase, and it's up 3.9% year on year, which is the lowest annual increase since May 2021. So all evidence points to the fact that inflation is under control and that the Fed is unlikely to raise interest rates anymore, that they've already completed their rate hike cycle. If you take a look at the Fed Watch tool, there's only an 18% chance they will raise interest rates in November and only a 40% chance they will raise interest rates in December. So we have got a pretty high chance that the Fed is done and inflation is under control. The second positive is that the economy remains very, very strong. You can see that after the last 2 quarters of positive GDP, we have got Q3 GDP now tracking at 4.9%. So with inflation under control, with the economy very strong, what is there to worry about? What's the main concern? Well, the main concern is that the 10-year Treasury bond yield or long-term interest rates, it keeps going up, right? So that has been freaking the market out. Specifically, again, the 10-year Treasury bond yield has been rallying very strongly and is now at 4.8%, close to 5%. And it's now at the highest level since 2007. So remember that the 10-year yield moves the opposite of the 10-year bond price. So what's the opposite of this? The opposite of this would be the 10-year Treasury bond price, which you can look at from the TLT ETF. There we are. So you can see that these are the long-term bond prices. It has collapsed. It's like down 50%. So bonds have collapsed in price, and as the bonds collapse in price, the yield goes up. And now the yield is at this very, very high level. Okay, so again, that is what is freaking people out. Now, so one thing you have to understand is that why are people selling the long-term bonds? Why is yields going up? Right? So again, there are two reasons. One is the fear of inflation. That when people think there's going to be inflation, they sell bonds and yield goes up. So that could be one reason. And I don't think that's the reason, because again, inflation is moderating. The second reason why people sell bonds is because they expect a strong economy. The reason why the 10-year yield keeps going up is because of a strong economy. And that's the main reason. So the point to understand is that higher long-term rates are not necessarily bad for the stock market. Why? Because high long-term rates reflect strong economic growth, which is good for corporate earnings, which is good for corporate valuations, which is good for the stock market. But higher long-term rates are a short-term problem for the stock market because they make stocks look less attractive in comparison to bonds. Okay? So what do I mean? So now some people say, why would you buy stocks? If you buy stocks, you have got risk, right? The stock could go up, the stock could go down. It could go up 10%, it could go down 10%. But if I buy a 10-year bond, I get risk-free 4.8%. If I buy a 2-year bond, I get 5% risk-free. So let me ask you a question. Would you rather buy a bond for 2 years and get 5% risk-free, or put your money in the stock market where it's not risk-free, right? It could go up 10%, it could drop 10%, it could go up 20%, it could drop 20%. Which one would you rather? Okay? And in the short term, people may feel that cash or bonds are safer because, again, it's risk-free versus the stock market, which is risky. That's why the market goes down in the short term, because people, they like to move into these short-term bonds. But over the long run, remember that in the long run, the US stock market returns on average about 10% a year in the long run. And 10% in the long run is a lot better than a 5% fixed return, which may in fact fall once the Fed starts cutting rates next year. Okay, so the point I'm making is this: is cash safer or stock safer? It depends on your time frame. So I tell people that if you need the money in the short term, if you need the money in the next 1 or 2 years, don't put it into the stock market. Keep it in cash, because in the short term, anything can happen. In the short term, the stock market could go up 20%, it could drop 20%. No one knows. So if you need the money for something, don't put it into the stock market. Keep it in cash. For example, last year, during the bear market, if you held on to stocks, you would have been down 18% on the S&P 500, right? Or if you held the NASDAQ, you'd have been down like 30%. But if you held cash and put it into short-term Treasury bills, you'd be up 1.39%. So again, in the short term, cash is safer than stocks, especially in a bear market like 2022. But in the long run, if you take a look at the longer time frame, in 2 years, 5 years, 10 years, you find that stocks are safer than holding cash or holding short-term bonds. Because in the long run, what you get from cash is, again, 3, 4, 5%, right? But what you get from stocks are a lot higher. So it all depends on your time frame. If your goal is to build your wealth for retirement, financial freedom, keep it in the stock market. But if you need the money in the short term, and keep it in cash. It all depends on your time frame. And if your goal is to build long-term generational wealth, don't be afraid of the market crashing, because the market will go down once in a while, but it will always go higher as corporate profits keep on accelerating over time. You can see, like I've said this before, even if you bought here before the crash, you bought here before the crash, you bought here before the crash, even if you were so unlucky and you bought before every crash, you bought here before the crash, you would still be better off over time than holding cash or just putting the cash into time deposits or short-term bonds. Yeah? So that's something that you need to really consider. All right. Now, I've showed this chart in my previous video, but I'd like to show it again. So again, remind you that currently, even though the 10-year rate seems very high, it's the highest since 2007, but it's at 4.8%, which historically is not necessarily bad for the stock market. If you go back all the way to the 1930s, the 1940s, you can see that the sweet spot for the 10-year Treasury yield is between 3.5% to 5.5%. That is the sweet spot. When the 10-year yield is within the sweet spot, the PE ratio of the S&P 500 is at its highest level, which is about 20 times earnings. And right now we are at 4.8%. We're somewhere here. We're within this sweet spot. So yes, if the 10-year rate goes way above 5%, if we go to 6%, 7%, yes, then we may have trouble in the stock market, all right? But right now, as we remain here, we are at a pretty attractive level, all right? So where are we right now on the S&P 500? Again, I've showed this chart before, but this is a more updated chart. Currently, our PE ratio of the S&P is at 21 times earnings, which is below the 5-year average of 22 times earnings and slightly above the 10-year average of 20.9 times earnings, okay? So in other words, the market is not expensive, but neither is it cheap on an overall basis, but it is at a fair price, okay? But if you strip out, like I said, if you strip out the Magnificent Seven, the highest growth tech stocks, then the S&P equal weight PE ratio is at 16 times earnings, which actually is undervalued. So in other words, if you take a look at the overall market, I would say that there are a lot of stocks that are actually very cheap. But remember, don't buy a stock just because it is cheap. Cheap crap is still crap. Only buy high quality stocks that are cheap. And yes, there are quite a number around. In fact, if you take a look at the consumer staples sector, which I'll talk about in my next video, there are quite a number of high quality consumer defensive stocks in the food industry especially that is now quite undervalued. That I think is a pretty attractive investment if you take a medium to long term time frame. So like I said, seasonally, the last 3 months of the year tend to be bullish months, especially during a pre-US presidential election year, which is this year. Now, especially if the first half of the year was very bullish, and then we get a very weak August and September, then the last 3 months tend to be even more bullish. So if you take a look at this chart, you can see that historically, whenever January to July was up more than 10%, as what happened to all these years, and August and September were both negative, then the following October to December, the last 3 months tend to be very bullish. So this year, 2023, January to July, we were up 19%. That checks all these boxes. We were down 5.8% for August to September. So what's going to happen the last 3 months? Well, historically, you can see that the average gain is 8.56% for the last 3 months of the year. So I remain very bullish. And again, the only wild card, the only joker card that could screw it up is, of course, this war that just broke out, as well as earnings. All right. So actually, there are two things, not one thing. Sorry, two things: the war and the upcoming earnings season. So as of next week, we're going to kick off the earnings season. Is it next week? Sorry, this week. Tomorrow, in fact, tomorrow. So tomorrow we have got Pepsi, Neogen, and AZZ announcing earnings. On the 12th of October, we have got Domino's Pizza, which I own as well. Walgreens, as well as on the 13th of October, United Health, JP Morgan, Wells Fargo, BlackRock, Citigroup announcing earnings. So earnings season is coming up. So earnings, again, could confirm the bull market or may screw up the bull market. So all eyes are on this earnings season. Now, currently, if you take a look at the global market, you can see there is a bit of a disconnect between stock prices and earnings forecast on a global market scale, right? So you can see that the earnings forecast in black, these are the forward earnings per share forecasts, have been rising, which means people are expecting earnings to rebound in the next few quarters. But the stock market has been pulling back in the last 2 months, right? So there's a bit of a disconnect over here. So it could mean two things. The first thing it could mean is that the earnings projections are too optimistic and they will come down, right? Or it means that the market will catch up once the company announces earnings that shows that it's as good as what people expect. All right, so all this will happen starting tomorrow. Again, all the market needs to do is to see that earnings will come in okay or better than expected for this bull market to continue. What's interesting is if you take a look at this chart, you can see the last 3 quarters, earnings were actually negative, right? So we're coming up to quarter 3. Last 3 quarters was negative. Now, analysts expect quarter 3 to also be negative, in fact. So you can see where's the forecast over here. Analysts are forecasting that quarter 3, right, which is coming up tomorrow, is going to come in at minus 0.2%. So analysts are already expecting a minus 0.2% earnings growth in this quarter's performance. So as long as we can beat that, right, and exceed that, the market will continue rallying, which I think they can, because historically, most companies tend to beat their earnings expectations. So all eyes on earnings, and let's see how that goes. Okay, there we are. S&P is expected to report a year-on-year earnings decline of 0.3% for quarter 3 2023. Actually, it's 0.2%. This has been updated. Now, on a sector basis, you can see that the majority of the decline is expected to come from the energy sector. Energy is expected to show a 38% decline in earnings for quarter 3, followed by materials and healthcare. Right? So you can see that it is these 3 sectors that is dragging down the entire S&P 500 in terms of the earnings pullback. Okay, but the rest of the sectors, communications, consumer discretionary, utilities, financials, technology, industrials, real estate, and consumer staples, all these are expected to deliver positive earnings growth. So in summary, if the war in the Middle East doesn't get too out of hand, and if the earnings season comes in better than expected or as expected, I think there's a high chance the market should rally another 8% to 10% to finish the year positive. Hope you enjoyed this video, and I'll see you guys in the next one.